We've got some numbers dropping in now. Kevin Green back with us alongside Diane King-Hull, our senior markets correspondent. So I think that the software stuff mostly moves the needle here this afternoon. But, ROST potentially too interesting, Diane, because it seems over the last 5 days, the best information that we've gotten, the most bullish stuff has been in the retail world.
Yeah, it will be interesting to see if that matches up, especially with what we've seen with, say, TJX and even Walmart. Obviously, Walmart being the Goliath of the group. And, even when you compare the shares of Walmart compared to the shares of ROST is up 10% year to date. And Walmart has been beating that. But as you mentioned, ROST looks like those results are out right now as well. And that is popping in the after hours. So it looks like, yep. EPS was $1.59 a share. That beat expectations. Revenue came in at $5.29 billion. That also beat estimates. The estimate was for just under $5.25 billion. So it looks like a solid number there on both the top and bottom line for ROST stores. And so that reinforces the narrative that we've been hearing from different retailers within the retail space, where the consumer is looking for value. So a value play like ROST holds up.
Yeah, rallying to $160 after closing at 152. And nice, beat 159 versus 149, sales 529 versus 524 billion. Enough, I feel like at this point, if you're not missing, if you're a consumer stock and you're not missing and you're beating, it seems like you deserve to be rewarded, Kevin, because that means that people have found you to provide value, to Diane's point, or unique quality in the case of some of the lingering higher end stuff that's gone well. Obviously, this is more of a value play.
Yeah, and this is where this company really shines, right? This type of economic environment where consumers are trading down, looking for more value within the market. And this is really what has driven their sales. They did highlight that operating margins increased by 1.15% for the quarter compared to last year. And that's another, once again, just a good thing to see, expanding margins in an economic environment that has been a little bit challenging for others. And when you're looking at the top line and bottom line growth, that's also something that's going to be a tailwind for them here in the near term. Now, Oliver, we always have to kind of preface this. ROST is really, really conservative when it comes to their guidance. I haven't seen a guide from them that they've really missed. And so I would not be surprised if they continue to have that type of tone and commentary on the conference call, obviously highlighting the fact that consumers are still strong in their segment, and they're getting other market share from other stores here. But just keep in mind, too, the stock can also kind of reverse, maybe pair gains if the street doesn't like the guidance or the commentary on the conference call.
Okay. I've been pretty surprised at how well ROST is traded next to TJ. Up 11% on the year. It's still a laggard with TJ up 28, but generally it's been pretty strong. And to me, it seems like TJ is still kind of like the gold standard when it comes to bronze, it's when it comes to discounters, It still is like number one in my mind.
Because TJX holds up. Honestly, TJX has really done well, even when you go back years. Like if you go back more than a decade, it's really held up well. Ever since, honestly, the Great Recession, TJX has, done well in terms of their just composition of product. And then the Marmax brand in the most recent quarter, when you're looking at both TJ Maxx and Marshalls, that segment did really well. And so it holds up well also, TJX holds up well because you have a combination of consumers, yes, looking for value, but you have high-end shoppers that shop there as well. And so they hit the mark with the mix of inventory that they had. Whereas ROST, they do well, as Kevin just mentioned, in an environment like this. If consumers have to trade down, they're trading down there. Look, I do actually know of a millionaire who shopped there before, but it was that person just was. They just needed something.
Well, the point stands. Is that it's like it's a deeper discount even within the realm of discount. And I'm absolutely not putting myself in the category of your friend, but I will say the last time I went to ROST, I was in Vegas. It was an emergency. I needed a belt. Don't ask why.
Exactly. You needed something.
And guess what?
Yeah.
They didn't have it. The place was a stinking disaster. And so I kind of swore it off since then. So I think that's kind of like the difference between the returns, where TJ's up like 60% in the last 3 years. I mean, Ross still holding on there. Okay, well, let's talk some cloud companies, unless you got some burning thoughts on Ross, KG, but I feel like that's pretty much all there is to say. All right, let's Intuit, arguably one of the most reliable software trades around. Taxes, one of the few things guaranteed in this life. We don't have to mention the others. So KG, how guaranteed are the returns here? How's it looking?
This is actually very interesting. So their Q1 guide is between $2.33 and $2.38. The street's estimates were for $2.79. So they actually missed that estimate. Revenue growth looking between 5 to 6% here. When you're looking at their full year guide, they did beat the street's expectations between $19.16 and $19.36. Street was looking for $19.15. And for their revenue guide, let's say that it beat the street's expectations, pretty much in line here. So it looks like they beat both top and bottom line for this current quarter. I would say mixed guidance moving forward. Maybe they have some commentary within the earnings report that is really causing the stock to move to the upside here, because a weak guide, especially for next quarter, and trying to back end load their performance moving forward here, seems like an item that the street hasn't really rewarded as far as share price appreciation in the near term.
Okay. All right, looking outward, their earnings could exceed the estimate. The revenue seemed like a good range for the fiscal year, above basically the average. Yeah, go ahead, KG.
So Workday and Equifax are announcing a strategic partnership to monetize employment and income verification process. That might be the reason why you're seeing the gains to the upside here. That partnership, maybe there's going to be some synergies there. Maybe that could actually provide them some passive customers getting onto their platform. Because once again, I just didn't see any other reason for the stock to really be popping in the after hours after that report, which I would say is mixed at best.
Okay, so you're talking Workday.
I thought the same thing. Same thing.
I'm sorry. I'm sorry. Yes.
KG. No, I was just going to say.
I'm sorry. I'm talking about the wrong company.
No, that's okay. That's all right. We got it. You're on Workday. That's okay. Go ahead, Diane.
Yep.
Well, I will say, going back to Intuit really quickly,
sure.
I thought the same thing. It didn't make sense, the response in after hours. We'll wait to see what comes up on the earnings call, especially when you kind of compare it to the what the mixed picture looks like going forward, or the cloudy picture, we'll say, going forward. But just to really quickly get into Workday's numbers. So in terms of the second quarter, we'll get into some of their verticals. Adjusted EPS was $1.75, revenue $2.09 billion. Subscription revenue was $1.98 billion. And as KG just mentioned, Workday, Equifax have a partnership going forward. And we did expect to hear more about some of their new customers in this quarter, because they talked about in their last quarter they had some new partnerships coming up. So we're getting more visibility on that right now with this partnership with Workday and Equifax. So Workday having the reaction in the after hours. They're actually a little bit under pressure in the after hours here for Workday.
Yeah, it's kind of interesting. It seems like relative to like the expectations, the Workday report is fine. Beating, but then coming off a little bit, and then on the flip side, Intuit swings to a loss, and the stock's trying to rally a little bit. So it's kind of a curious kind of dichotomy in the way the market's treating these two companies. The other thing I would just say, though, is that Workday, it's kind of what it sounds like when there's work. When employment starts to slip and the economy slows down a little bit. I mean, the fewer people you're onboarding, the slower hiring gets, the less people move from job to job, then the less the software, arguably is going to be in play. But I'm not sure that's totally what's happening here. I'm not saying it's a macro thing. This is now the third earnings in a row where it looks like Workday's going to get hit. The last two also led to pretty big sell-offs. Yep. Diane?
They did. I was going to say that, and they highlighted that in their last earnings call. The CEO talked in their last earnings call, and it'd be interesting to see if that message is reiterated on today's earnings call. The macro picture and some slowdown they said, quote, we are seeing customers committing to lower head count levels on renewals. That's what they said on their last earnings call. We'll look out to, and that was what the CEO said. So we'll look out to see that, because they said at the time we expect those dynamics to persist in the near term, which at the time was reflected in their revised guidance. So we'll want to hear more on that if that pattern is continuing.
Okay. All right. So Workday down here. Going to extend that. Let's close with Intuit real quick. Let's come back there because the stock's been sitting right below its highs, trying to get through the 675. They go to a loss. The stock rallies anyway. As I mentioned, their outlook seemed to be pretty solid with the range that does exceed the estimate. So it didn't seem like a terrible report. It's also, though, got a little competition from peers and the government, too. So there are some kind of like secular headwinds here to a very reliable business. But how come we're kind of forgiving the swing to a loss, KG? Is that like a seasonal thing for this company or what?
No, I think it's the $3 billion buyback that they did authorize here. And so that's another reason why you could see a stock move to the upside. It's going to take shares available that are available in the float down. And so that should actually improve your metrics just because of the financial composition of how buybacks actually do occur. And then they do make some commentary around the AI front and how they are seeing actually benefits from product offerings that do integrate AI. And so that might be another reason why. But I would say it's probably more of the share buyback. $3 billion is a lot of money for a company like this.
Okay. Yeah, all right. Also buying up the shares at near the highs, so a little questionable. All right. I think that's it. Thank you guys very much.